Vertical bear spread, as the name implies, is an option strategy where we are bearish in the trade. That is, we are expecting the price of the underlying to go down. And it is an option strategy where you buy a put option at a higher strike and simultaneously sell a put option at a lower strike. And we set up this trade in such a manner that we are able to define a maximum gain and a maximum loss. And in any trade where we can define the maximum gain and maximum loss, in general, the thumb rule is we'd like to set it up in such a way that our reward to risk ratio at a very bare minimum is 2x. Ideally, the higher the better. So let's illustrate this with an example. So here we consider a stock called Axis Bank, and Axis Bank is one of the premier Indian banking stocks. Assuming that the current spot price is 546, and here we buy a put option at a higher strike of 540 and simultaneously sell a put option at 530. So to buy, we pay a premium of 10 bucks, and to sell, we collect a premium of 7.8 with a net spread being minus 2.2. So since we bought at 10 bucks and we received a premium of 7.8 while selling another put option, our net payout is minus 2.2 per share. And since one lot has 1200 shares, so in money terms, our net payout is minus 2600 bucks. So our net payout or our net spread, money spread, also defines what is the maximum amount that we can lose in this trade. So the smaller, the better. Now let's see how this plays out under various spot price scenarios which can happen at expiry. So currently we are here, 546, and at 546, if the price were to expire at 546, we'll incur the maximum possible loss this trade can have, which is minus 2600 bucks. And for us to achieve a break even on this trade, the price has to fall by a little under 2%. So if it comes from 546 to even a little above 537, we already had a break even. We are not going to lose any money. And if the price were to drop about 2% and come from 546 to 535, we make a profit now of 3200 bucks, which represents an ROC of 3%. And to achieve the maximum possible gain that this trade can fetch us, we would want the spot price to drop by about 3% from where it is today. So from 546, we'd want the price to come down to 529, which is about a 3% drop, and this represents the maximum possible gain this trade can achieve, which is 9300 bucks in money terms, and about a very impressive return on capital of 9%. So we deployed a total capital of about 1 lakh, and against that we can get a maximum possible reward of 9300 bucks and incur a maximum loss of 2600, which gives us a beautiful maximum gain to maximum loss ratio of 3.5. So this is a bearish trade. When we are reasonably sure about the price of the underlying to go down at least by 2 to 3%, we'd like to set up such a trade. It protects our downside. In fact, it caps our downside, and we can maximize our reward potential at a very low risk level. So setting up any kind of a trade wherein we have a maximum gain and maximum loss very well capped, and such a way that our maximum gain to loss ratio can be in excess of, let's say, 2.5 or 3 times, can be an excellent trading strategy. So in the next video, we'll talk about another vertical spread, which is called a vertical bull spread. And as the name implies there, it is a bullish trade.